Accounting equation and Excel. Adjusting entry for prepaid insurance. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 5 tabs down below: example, in essence, answer key, month 1, first month of operations, month 2, second month of operations, practice tab, having pre-formatted cells so you can practice the practice problem with less Excel formatting. The ADJ tab, the one we will be working in, is where we started with a blank worksheet but are basically working within a template at this time. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing this time. Remembering we're basically building our bookkeeping system using the accounting equation as, in essence, our trial balance from which we can construct our major financial statement reports: balance sheet, income statement, statement of equity. We started out in the month 1 tab, entering the first month of data input, which we closed out, and then did the second month of data input. And then we put together our worksheet for our adjusting worksheet after we're imagining 2 months of data input for our adjusting problem, remembering that normally the adjusting entries can often be thought of as a separate entity, such as the public accounting firm, CPA firm, tax preparer, getting the information from the bookkeeper or accounting department, possibly with the help or use or access of QuickBooks or Xero, extracting the information from the software, putting it into their Excel worksheet, which I would still typically do even if I had access to the QuickBooks file or Xero file, so that I can see the adjusting entries in a more transparent, two-dimensional way as opposed to within a database program. Although normally I would use debits and credits, here we're basically using the accounting equation in a similar fashion. Remember that even if you did both sides yourself, you did your own bookkeeping, you did your own tax preparation, you still might want to think of it as 2 separate activities because they're basically having different primary objectives. When you're doing the data input, primary objective, dealing with the people you have to do business with, employees, vendors, and customers, as well as automating the process, making it as unintrusive in the operations of your business as possible while still providing the information you need. Whereas when we get to the end of the year, we are looking to create the financial statements in the format necessary, which might be accrual format for external reporting purposes, possibly for the bank or investors, or in the tax basis, at the least, for tax preparation. Now, normally, therefore, the cutoff date might be the end of the year. Our cutoff date is going to be at the end of the second month of operations because that's how much data we have, right? We've got 2 months. We're going to imagine we're going to do the financial statements as of the cutoff 2/28 or 2/29, depending on the leap year or whatever in our generic problem. All right. So now we're looking at the adjusting entry related to insurance. Now remember, when you're looking at adjusting entries, one way you might analyze, say, a client, for example, is to look at the balance sheet accounts, and in particular, the balance sheet accounts, right? Because most of the adjusting entries, classical adjusting entries, have a balance sheet account, or at least one balance sheet account and one income statement account. The balance sheet accounts are the permanent accounts. So typically, we can kind of look through the balance sheet accounts and say, is there an accrual component to this balance sheet account? Like accounts receivable has an accrual component, inventory has an accrual component, the furniture and fixtures. And if so, is there then an adjusting entry typical to that type of account? In this case, we're looking at the insurance account, which is the classical prepaid type of situation, where we pay for something before we get the service. So remember, the idea of insurance is, and this gets a little confusing, by the way, because some insurances, because of government kind of manipulation and whatnot don't really act like insurances, right? Like health insurance, you pay for insurance in order for them to cover your doctor's visits, which isn't really kind of what you would think of with insurance. Usually with insurance, you're paying for coverage in the event that something happens in the future that is unlikely to happen. If it does, then you're covered under that, such as liability insurance is going to be like the classic example and one often needed for a business entity, for example. So we can compare insurance costs to something that would be a normal business expense like utilities, the telephone bill, for example, in which case we already used the telephone and they're charging us for the use that we already did. We've already incurred the expense in essence when we pay the bill. Whereas with insurance, we're going to have coverage in the future. We have to pay for the insurance before they give us the coverage, because the whole idea is that we're getting coverage for something that might possibly happen in the future. And if it does, that's when the insurance activates, such as liability insurance. If you're in California, it's almost a sure thing. Some crazy person's going to sue you, right? So you kind of need insurance. And then, but, you know, hopefully if you're in like normal, not crazy town, then it's unlikely that some crazy person's going to sue you or something like that, right? And so you're paying for the insurance just in case that happens. So that means that from an accrual standpoint, we have a difference between when the cash is paid and when the service is provided. Also note that you might get the impression with insurance that they don't actually do their job until the crazy person sues you, and then you pay for the lawyer, and then the lawyers get rich, and all the money that they pay to the lawyers, and then the lawyers get rich, and you just try to protect yourself from the crazy person, right? But even if the crazy person doesn't sue you and you don't get any benefit from the insurance, you still did get a benefit. We got the benefit of assurance, the coverage, the lowering of the risk. So that's what is going to happen over time. And that's how we apply out basically the benefit. Now, if we paid insurance month to month, then it might still be close enough for us to just basically expense the insurance when the insurance happens. But oftentimes it's cheaper to pay for insurance at least a year in advance. So now we've prepaid a year in advance. We have a similar scenario as to the property, plant, and equipment, which is often a more extreme and tangible scenario. So just a quick recap of that. The most extreme scenario of this kind of prepaid situation would be, what if I bought an office building for $100,000 and I paid cash for it? Would I then expense it as office building expense? Naturally, most people would say no, because the building's an asset. Why is it naturally an asset in our mind? Because we're not going to consume the asset yet. It's going to sit, we're going to hang on to it and use it. Therefore, we should be allocating the cost over the useful life of the use of the building. So similarly here, you have the prepaid insurance, meaning I haven't consumed the insurance yet, and therefore it shouldn't be an expense yet. It should be an asset, because it's something that I'm going to consume in the future for the use within the business. That's the general idea of it. Now, from a logistical standpoint, the question is, how has the accounting department done this, right? Normally, classically, in a book problem, we would say, even if you had bank feeds in your QuickBooks system, you just set up the bank feeds from the bookkeeping side to always record insurance not to an expense, but into an asset account. So that means every time they buy the insurance, it's just going to increase the asset account. The asset account is never going to close out to the equity like the income statement does. The income statement closes out to equity. The asset accounts go up forever. Therefore, we need the adjusting entry. So the fact that there would be something in this insurance, prepaid insurance, on the balance sheet would tell us, hey, we need to look at that account and make sure that we do the adjusting entry to record the portion of the prepaid insurance that has been consumed, meaning the part of the policy that has passed, the time period that has passed, and expense that portion according to the accrual basis. That would be the general idea. Now, some bookkeeping systems, they might not do that. They might naturally say, well, I'm just going to expense it because that's what I'm used to doing. If that happens, then what we have to do is say, okay, look, this is a business. There's no insurance, prepaid insurance on the balance sheet. Is there insurance on the income statement? If there is, then of course, which there possibly and normally would be because most businesses need at least liability insurance, then we should say, okay, now that it's an expense, do we need to do basically a similar concept, but the opposite journal entry, decreasing the expense for the amount that has not yet been consumed, putting that on the books as an asset. Now, note, you can do it either way. You can do it either way, but traditionally, we want to put the expenses on the books as an asset. Why? Because it's easier. Because the permanent accounts will not be adjusted for a temporary adjustment at the end of the year. They're not going to close out to equity. So that's going to be easier to do. So when we're working between our bookkeeping or accounting system and between the adjusting system, typically the scenario will be you can automate your bookkeeping system. Every time the check clears for insurance, just make sure it doesn't go to insurance expense on the income statement, but rather prepaid insurance. And then make sure that the person that does the adjusting entry will do an adjusting entry according to the policy of the insurance, lowering the amount that's in prepaid insurance for the amount that has been consumed and recording the other side to the expense. Okay, that's the idea. Let's see how it works. Adjusting tab, we're going to say this is going to happen on 2/28. I look in my sheet over here. I see that I have $12,000 in prepaid insurance. So we're going to say, okay, we need an adjusting entry for insurance expense. So what would we do then? We'd get the insurance policy and say what period is covered by the insurance policy for which we paid the $12,000. So we're going to say the cost for a year. Let's say that the year cost $12,000. We're going to say that the insurance happened, we'll say, in the start of February. So we're going to say that the insurance took effect in February, and we have a year of transaction of insurance that will be covered. So then the question then is going to be, all right, well then the months in a year, in a year are 12. So that means the expense or coverage, let's say coverage per month is going to be the 12,000 divided by 12, which we made to come out nice and easy. I'll put an underline here. So that means that we're going to have $1,000 of expense per month. Now, obviously, the months that have passed, months past is only 1 month. I'm going to indent this. 1 month has passed because we're going to say that we bought the insurance. It was covered for the period of February. So February coverage has passed, and then we have 11 months into the future. So therefore, the prepaid, the expense, the expense entry is going to be 1,000 times 1 month, or of course 1,000. So that means that we should have an expense for the 2-month period ended of 1,000 because only 1 month was actually had the insurance coverage. We didn't have any coverage for that first month, so luckily no crazy person hopefully sued us during that time period. So we have prepaid insurance then. So that means that the months remaining are 11 months, right? So now we have prepaid insurance should be remaining of 12,000 minus 1, or you can think about it this way. It would be 1,000 times 12 minus 1, 11 months. 11 months remain, so prepaid insurance should still have 1,000 in it. I'm going to indent that. So that means, what's my journal entry going to be? It's going to be $1,000 decrease in the insurance expense, resulting in prepaid insurance of 11,000, which represents 11 more months, which are in the future, therefore not yet consumed. The other side go into insurance expense for the amount that has been consumed in the period that is covered. So that's going to be the idea. Now, note one other thing that's kind of confusing with some of these prepaids. People get confused with the fact that they're going to say, hey, look, I already paid cash for it. I've already paid for it. How can it be an asset if I've already paid for it? Because it's not like I'm going to pay for anything in the future. And it's like, even though you're not going to pay for it, we still consider it an asset because it's something that will be consumed in the future. You can't really get out of it. You're not going to get the $12,000 back in other words, right? But it's not something that you have yet consumed. And a similar concept would be applied if you prepaid for rent, for example. If you said that I'm going to pay 5 years rent in today, and I've already committed to that, there's no way out of it. I've already paid the 5 years of rent. So shouldn't I just be able to expense the 5 years rent? And because that's more substantial, the people can visualize the rental property and using the property, it might be more obvious to say, well, no, you can't do that because you haven't consumed the use of the property yet, right? You still have to be given the use of the property. If you didn't get the use of the property, of the rental property, then maybe the contract would be broken and maybe you can adjust the contract. So sometimes that's a little bit wonky or difficult to understand. And sometimes if you're in public accounting and you're talking to like a CEO or something, the owner of the business that's more cash-based minded, these accrual concepts will be confusing to them, or they won't like it so much, right? Because their mindset is on the cash basis, and you're going to have to kind of say, well, this is why we have to do this, because this is what we have to do for accrual accounting and or for tax preparation. We have to follow whatever the rules are with regards to the tax preparation. Remembering for taxes, the idea of the IRS is going to be skeptical of the abuse of the difference between when cash is received or paid and when revenue or expenses are incurred. So like if that scenario happened for the rent and you paid for rent 5 years in advance, then the IRS is going to say, well, there's no way we're going to let you do on a cash basis, even if you're a cash-based business. Why? Because you're manipulating the system. You're trying to get an expense 5 years early by just paying the cash now, even though you haven't actually consumed the use of the facilities, right? So that's how the cash basis can actually be used if you had cash flow to distort when you would have the expense, which the tax code is going to try to stop from doing by making you do an accrual thing sometimes, even though you might be on a cashed basis in some cases. All right. So let's say we have the 1,000 insurance is going to go down for 1,000. We'll say decreasing by this 1,000. And the other side's going to go into insurance expense. Insurance expense over here somewhere. Donde insurance expense negative because it's bringing down the equity of the 1,000. And then we'll just zero across the board, baby. Zeros across the board. And so there we go. Yo. And almost there. There we have it. Okay. Bringing it back. Let's pull down the balance. I'm just going to pull it all the way down. We'll get a lot of zeros, but that's okay. Boom. Transaction still in balance. Classic adjusting entry where the asset, let's go scroll up, and I'm going to put my cursor here and do the view tab thing and freeze the panes so I can see that top bit. So now I can see classic adjusting entry because there's a balance sheet component to it and an income statement component, meaning there's a timing difference kind of that's happening with the adjusting entry. Now you might ask, is there going to be a reversing entry to this, as we talked about similarly when we saw the for example, the cutoff situation with the accounts receivable, which we said that one did have a reversing entry. This one does not. Why? Because this is a permanent change. This is a permanent change. It's not that we tried to pull something out that was in the wrong time period and therefore have to reverse it because of the timing difference. This is a permanent change that took place because just of the way that we set this up, in that the bookkeeping or accounting department's just going to increase all the time the insurance, prepaid insurance, and then we are the ones that permanently decrease the prepaid insurance in accordance to how much of that prepaid insurance has actually been consumed, and therefore we're not going to reverse it. All right, so then let's put the balance down here, and we'll bring down the balance. Let's put an underline. I need an underline for formatting's sake. And so we'll go home tab. Wait, that's not the home tab. What was that? What would that do? All right, let's go try it again. Home tab, underline, and the font group. And then we will sum up equals the SUM, prior balance, current activity, enter, Control C, right arrow, holding down Shift, right arrow, ba-boom. And then we're gonna right click and paste it, just the formulae. And then, because the formulae don't lie, I'm gonna select these three, and then I'm gonna pull this down. You know, I went to a conference and they had 2 meals that they were gonna serve, and they called them the A tray and the B tray. The A tray is the one I ordered because it was the steak, and the B tray was the vegetarian one. So I ordered the A tray, and they totally betrayed me with the vegetarian one. They totally betrayed me. They're like, "Oh, I didn't know that we betrayed." It's like, no, I know what happened. You ran out of the steak. No one wanted the vegetarian one, and then you totally betrayed me with the B tray. Anyway, so that's where we're at. So then we can see over here that of course brought down the net income. So now we're at net income of 3797. Let me check that too. Well, yeah, 3797. So that looks good. All right.